All right. Thank you for watching this. I hope everyone is safe and happy in these confusing times, and I hope everyone's doing this whole social distancing thing and everything, keeping themselves safe. So, my name is Sid Chaudhry, and this is going to be a short video about basically what I think the probability of what's going to be happening in the market, and this is something to this is to say that this is not exactly a we don't know the future, but what I'm going to be positing and kind of discussing is the possibility and the probability of why the market might crash again. And if that is so, what's the reasoning behind it, and what can he do about it, right? So essentially, what we're gonna look at is, first, if maybe I should introduce myself better. So I'm a trader, and I've been trading for some time, and kind of like to establish myself. Essentially, I have some experience in the markets, so whether that be in my own right, as a retail, guy investing and trading in his own account for other people, and also I've have experience in the stock market, working for other institutions, trading firms, brokerage firms, things like that. You can look me up on BrokerCheck, on FINRA. FINRA is the like what they call like commission. I'm sorry. I hope you don't have allergies like me. I mean, it's a beautiful day. This is what 12th of April, and I'm dying from allergies. At any rate, that's a tangent. So basically, you can look me up on BrokerCheck or So as I was saying, FINRA is the commission that monitors and regulates the financial industry, and you can look me up there on BrokerCheck. You can Google it, look my name up, Sid Chaudhry, and I'm gonna be there, right? So this is all to say that I do have some expertise, some experience, some knowledge in the markets that I'm bringing to bear in order to discuss this. My position, and my position is the probability is pretty high that the market might crash again. If it doesn't outright crash, it definitely will be going down again. Definitely, as in like in my own analysis. And I'm going to be showing you a few, kind of like the information. And I think that, we don't know the future, but it's always better off to have some kind of knowledge, of have some something in your back pocket just in case something happens, right? And you know how to deal with that. And that's something I will talk about, how to maybe keep yourself safe, from a big drop in your account, using some cheap methodologies, let's say, where you don't have to spend that much money to have like insurance, let's say, on your positions. Now, a lot of the people that are going to be watching this video will be people with 401k accounts or whatnot. If you're a trader, I'm assuming that some of these people who will be watching this video will be traders, and for them, I mean, it's like I'm sure I'm giving the benefit of the doubt that they know what to do. But this video is going to be more so speaking for a lot of folks that are kind of like maybe scared or whatnot, because already their accounts, 401k, what have you, has taken a big hit. I mean, not only that we have to worry about safety and from a physical standpoint, but that this obviously has impact in the market, right? Impacting the economy, but this is specific to the effect of the economy. What effect does it have on a market where most people's investments are tied up? So you have a 401k, you have some investment, someone's managing, someone's I don't know, you have an endowment fund if you're that rich. I mean, I mean, then you got like some big shot money manager handling your account. That doesn't necessarily mean they don't know what the hell they're doing, but be that as it may. Um, so yeah, so basically we always have to understand that, kind of look at the situation that we have, and then have a projection based off of that, and the projection is based off of what the probabilities of something happening or not. My projection is that the highest probability of the possibility of a move in the market, or by market I mean the stock market really. I'm not speaking of necessarily futures or forex or whatever, bond market or whatever. This is kind of strictly regarding the average person, and the average person's money is tied up in in the stock market. So, and the effect of the economy in the stock market is, again, my position is that my projection, let's say, is that it's highly likely that you're gonna have a drop in the market. So now, so to go over, what we have the situation right now. Obviously, I mean, everything's being impacted by the coronavirus, right? So basically, the whole market is taking a hit. If nobody's going to a job, how are you going to make money? And if the company doesn't make money, they go bankrupt, and they go bankrupt, the valuation in the stock market goes from a bajillion dollar to zero, right? So that's basically the problem, right? And this is something that nobody has ever seen before. Someone like Warren Buffett himself said that in all his years he hasn't seen this ever, and it's demonstrably true that it has been a long time since, at least since a long time, at least since. I mean, when was the last time we read about pandemic, right? So. Basically, this is a situation that we haven't really faced ever. So, someone like given, so this whole situation is the economy, the market, everything that's getting impacted is almost solely due to the coronavirus, right? And again, like, this is something that we have never seen before, at least not in in memory, right? Or recent memory, or even not so recent memory. So the aspect of the way that it has impacted the market, so to speak, how do you deal with it is more important, is that people have dealt with it ever. And this is something that nobody has really game plan, so to speak, right? And so the effect of this is, in my opinion, a lot more intractable than what people are assuming, because people are just having the best hope, like they're just hoping things will turn out good, right? So the establishment, so to speak, the people who affect the market, the people, the big wigs, that's something that obviously they're not gonna outright say that we are, in the deep, right, deep in the weeds, because people will panic, and you don't want people to panic. I mean, then I don't know. I mean, the politicians don't have jobs, the money manager don't have money because people take the money out. There's everyone wants to have like a soft landing, right? But what I think though is that, and you can see some of I actually have some other channels. You can go to like Trading Stream. That's one of my channels where I stream. And again, I'm starting this whole video thing recently, so I'm not that pro at it, let's say. Or you can go to the Trading Show, where I did some again, live streams of like some shows about like what I think about the market. So if you go back, and actually I have predicted this before this happened, that the market will crash, and we are going to be facing this for some time. And that's I don't want to pat myself too much in the back, but quote unquote, I was right, right? So. And that is because, again, the authorities, let's say, don't want people to panic, because that means people lose confidence in them, right? in the authorities, so to speak. So that's their motivation. Why it's like people hoping their best that things will just turn out good, and I don't think that's necessarily going to be the case. I mean, we might not exactly have like some kind of a hellscape in the future, but definitely compared to where we were before, it's going to have a lasting effect beyond most people's estimation right now. So if the contrast between and the comparison between what's happening now, a lot of people would say, what happened and compare this to like 2008. Some of the few data that I can tell you right now is that, for example, last week there were 6.6 million people that got themselves like on the unemployment roll, right? So in other words, that were who were claiming unemployment. So that's, and this is a mind-blowing data, because in 2008 the worst week, right? It was like, I believe, like 400,000, something like that, or something like 300,000, and 6.6 million was about like if you go back to 2008, you have to have like, it was like 28 weeks when you add them up, 28 weeks of new unemployment claims. When you add them up, that's still smaller than 6.6 million, right? It's right about the same, actually. So, but that goes to show how deep this is, and this is not something that, what happened in 2008 was something that more financial related. Essentially, you had assets a lot of people had that were not really what they thought they were on the books, off the books, and essentially people were going bust, and that created a financial problem. And essentially, money was think of it like money getting stuck and not going anywhere. And so what the feds did is basically, it's kind of like, I don't know, you got a like clogged drain pipe, and they just like, I don't know, jiggled it or whatever, and made it flow again, right? So because they took some steps, they started quantitative easing, which is to say that they started to buy debts and products and that kind of stuff to, kind of like recapitalize the market so money can keep flowing, and lower their interest rates too. That way, the cost of business becomes lower. So again, money can flow. This is not the same thing. This is neither fiscal or monetary problem. This is the start of it is not that. The start of it is almost like historical. It's beyond like anyone's control, right? It's a pandemic. It's a disease that spreads over everywhere. If you get in, touch with others, highly contagious. Even if it doesn't kill you, it definitely makes you go through a lot of shit. It also, it's a bad disease. It stays with you. Again, it's something nobody has seen before. It's not like people have like immunity to it, or there's no like base level that you can compare to, that you have understanding of the base level of this disease, right? And so that's what's driving everything, including that people are not going to their jobs, which means that again, companies are not getting any money, right? And the projection then becomes, when can we go back to work? We don't know. And when we go back to work, to what extent that we will be having the same amount of output activity that we had before? Probably not the same, and at least not right away. And so based off of that, the projection for this and the next quarter is that by next quarter, a high projection by even Goldman Sachs, they're expecting GDP to go down by, quarter to quarter, that is, by like 50% or something like that, 40-50%, which is pretty massive. I mean, that has never happened, right? And again, this is our uncertain situations. Now, so this is some of the hard data. this is the kind of like the context that we're in, that the context we're living in, that's affecting your 401k or other people's trading account, investment account, what have you. So now, you know, in the short term, and I will kind of draw it out now. And this is, I'm going to go into now, like, you know, technically speaking, what has happened in the market, and then I'll switch on to like, you know, what can you do about it, essentially. Again, this is not like something that is, you know, I'm not God, you know, we're not God, neither are you, but what I'm going to be showing is my rationale to why I think the highest probability move in the market will be going down. If not outright crashing, I believe it might just crash outright. And on top of that, you know, at the minimum, if you get away from this, to maybe think about that, or from this video, if you just think about that. And also I'll go over a few ways that cheaply you can maybe have some insurance, that way if something happens, you're not really, you know, shit out of luck, right? So yeah, let's go ahead, and I'm just gonna draw something here, or draw the market. So what happened is we had a high, it's all-time high on S&P 500, about like 3,373, right? And the market crashed. It went down to 2237. Like I said, check some of my other channels where I went over how that might play out and how the market will be affected. I was expecting a crash. I couldn't believe the amount, the crash that happened. I mean, it was mind blowing, and nobody has ever seen a crash like that, right? And that goes to show, you know, the amount of panic there was. Now, there's actually three possibilities. One is we just had a correction. That's gonna be the most massive correction you've ever seen. Two, it's a bear market, right? A bear market is basically a really big correction, and it keeps on happening over a long period of time. It's not necessarily systemic necessarily. It doesn't have to be systemic. By that I mean, it doesn't have to have an economic reason, let's say. A lot of it is just like inventory reduction, things like that, you know, overproduction, and, you know, that's normal. And usually, you know, when something goes like below like 20% or so, you know, market goes down 20%, and we're there for like, I don't know, bear markets last a year or two, right? A year or so, somewhere a year or two. I mean, it's all, again, all ballpark, right? All generalities I'm dealing with here. The market, you know, the market is generalities effectively. If you trade every day, maybe, you know, it's not, but you know, we're dealing with more of a projection, outlook, probability based. So it's going to be a little bit general. Gist of what the market might do. Now, so if the way that the market has moved down, you know, let's say it's a correction. Again, if it's a correction, at the same time though, you have again projection GDP. The projected GDP will be going down by 50%. You know, quarter to quarter, next quarter. You know, next quarter, according again Goldman Sachs. When that happens, that's usually, I mean, that's not a correction. When something like that happens, which is fundamental, it is not a correction, right? Correction happens because everything was overvalued. There were people who were just it was too frothy. People were just buying, you know, and all of a sudden, some people who were taking their, you know, profits, and market went down because everything was too expensive. That's normal. Whenever you have other coincidental things that are happening that are more fundamental, or things that act as catalysts that are more fundamental, those are not a correction. Generally speaking of a bear market, if not an outright recession, those are usual recessions we're speaking of. If it's a bear market, again, a bear market will become more of a consistent correction and a really high drawdown of the market. Again, normal, that's normal stuff, not a big deal. But again, in this situation, we have a lot of other things that are happening at the same time, or has happened, and that has precipitated a market crash, right? So in other words, that is also happening with other fundamental things that are happening that are pushing the market down. that is not a correction. That's not characteristic of a correction. Again, characteristics of a recession. Recessions in quote unquote is where you have two consecutive quarters where the GDP goes negative. In this case, it's going half negative, according to some people. Estimation went from at first like, second quarter will be like, we'll be down 10% GDP, 15, 25 now, up to 50. One Goldman Sachs was saying about a week back, right? Now the other one other aspect that I guess I should talk about before I go on the board is markets. When something crashes, a lot of time they're getting priced in. So if you have a bad news, right? Let's say at the depth of the bad news, market will be going up. That is because people were already predicting that and the market already had a bottom before the bottom of the bad news, because people have priced that bottom of the bad news already, right? So in other words, the market is a discounting mechanism. It discounts what's happening in the future. In the future, someone expecting that they'll be really bad. Let's say today, I don't know. Let's assume that we're not talking. Let's not talk about this pandemic. Let's say it's something more usual that we have just seen before. I don't know. Exports are down or imports are down, and the economy is doing bad. Well, the market, what it does, it's projecting in the future, and people are investing, and I don't necessarily mean everyday people. I'm talking about the big boys, the big players. They're investing based off of what they're projecting in the future. And they project, let's say, 3 months to 6 months from now, the economy will be at its lowest. So guess what? The market right now, then they start buying, because essentially they're pricing that in. The people who have, when the economy started to go south, before they started to go south, the economy, the long-term investors, they project that, and then they start selling in the market. So, and so that's where it starts. And before, let's say, the economy makes a bottom, the market has made a bottom, and then people project, the economy, the market is already low. The economy will be going up pretty soon, and so let's buy. And market goes up before the economy goes up. So, because people are predicting the economic, lows has already, they have already priced it in when the market went down, right? So that might happen now because the market went up by about 550 points. That is possible. That has happened. Again, I'm gonna position my projection as to why that is probably not the case. That's the case for that is a low probability case, right? And yeah, so essentially the market now has bounced up 550. This reason I'm doing this is because if I'm right, you should probably sell out. Oh, by the way, I'm not recommending or advising or anything like that. I'm just gonna go over maybe some cheap ways you can buy some insurance. And so. So basically it went up, we were at 33.73 at the top or something like that. I believe 33.80, something like that, which is all-time high. It went down to 20.37 within a span of like 3-4 weeks, right? Which is pretty astounding. I mean, it's I'll never see that in my lifetime. I'm like what, 37? So that's the context we're in. So whenever something goes down that bad, generally speaking, it will rebound a little bit. But since it's such a hard move, the rebound is also hard. But that doesn't mean the basic downturn hasn't been done yet. Because if we're in a recession, it's supposed to go down again. The market should roll over and make another low. That is because it is not a correction. A correction, you might have a strong downturn, strong down move up again. But in a recession, you have the market does a strong down move, and then it kind of starts to consistently go down. because the underlying condition of the economy is also down, right? So there's a reason, fundamental reason for it to keep on moving down. Okay, so now if that is the case, if it went up, something like from 22.37 on Friday was at 27.89, I think 27.89, that's like 550 points, right? 550 points. That's a really good rebound. But what I'm positing is that that's really a dead cat bounce, and that's trap basically. Because if it is a recession, the market will kind of roll over again, and nothing goes down forever. Like, I mean, let's say this is kind of like common sense. Market just doesn't like poop go down. I mean, it kind of like go down like a stair step fashion, right? This stair, though, it's more like an elevator. It's not exactly like it's not like a 45-degree stair. There's a saying in the market, when market goes up on a like a stair step pattern, and when it goes down, it jumps off the window, right? But the point being that it doesn't just go down just every day. It goes down, goes up again a little bit because people think, oh, you know what, I'm gonna buy some. It's cheap. So, and that's when people get trapped, because a lot of people, especially someone who might not be invested in the market or kind of doing this for the first time or whatnot, they will, everything's cheap, let me go buy. But if you do that, your money might get stuck for some time. And if you don't want to hold on to your positions, you might have to sell at a cheaper price later, which what I will go over is how that that works out. And usually that is when you find the bottom. Anecdotal evidence is also like, I have friends and family calling me and asking me, hey, should I buy? Looks like it's a good time to buy. No. Usually when that happens, and this might sound a little bit, a little bit off-putting, but usually when you have a lot of like retail traders, retail clients, everyday mom and pops, think of putting money in the market, usually that means they're not fearful enough, right? When everyone says, I'm not going to put my money in the market, guess what happens? The market doesn't have any cash. Just think of it like this: capital, cash inflow, outflow. If everyone says no more money in the market, well, the market has bottomed, ironically, because there's no money in the market. That's when you buy, ironically. When people say, hey, you know what, I'm going to put some money in the market, what should I buy? Usually that means that that's not a bottom yet. If we are in a recession or so, or if in a bear market or so, right? So that's kind of like the context of where I'm coming from. Now, I'm just going to show a little like the way that pricing works, or let's say how markets generally move, especially when it enters a bear market or worse, a recession. So let me show you something. And I got my dog on my, I don't want to step over him. Okay, so we were at, let's say 3,400, and sorry for the shitty handwriting. So what happened, essentially, the market went down like this, more or less, at 22. Let's just ballpark at 2250, and again ballpark it over there. So now it's up to, like, let's say 2789. Let's just say 2800. So almost like it went down 27. So almost close to 50%, right? So like 45% rebound. So now what it could go up, right? But at the same time, it could go up on the basis of, what exactly? Like, we don't know how. This is a situation where we don't know what the future possibilities are. Like, we don't know what's going to happen beyond even next week. A lot of the projections, this is something really brand new, right? And the effects of this will linger for a long time. In other words, let's say we just go back to our job. Let's say everything's fine in a month. Okay, that's great. And if you watch some of my other videos on Again, Trader Sid or Trading Show or Trading the Trading Show or the Trading Stream, all the trading. You're gonna see, you're gonna see some more rationale, as to where I'm coming from, but and the context is that this is something we don't know how this is gonna play out in the future. If this was like again, we're going back to a job, great. But even if we go back to job in a week, in a month, the fallout from this to fix this, and it's gonna take a year, right? I mean, this is not gonna be the effect of it. By that I mean, okay, so all the supply chains are just like, like they're dislocated. People's jobs are dislocated. People's investments are dislocated. Big companies, especially small companies and medium tier companies are all just busted out, right? So think of all that. To fix all that, capital flow, is all dislocated, right? So to fix all that, it's not like a month's work. It's like a year's work. Years work. So market might keep on moving up. That is possible. That means that people were discounting that at 22.37 or 22.50, let's just say 22.50, that they have priced it in, all the bad things that are going to happen. But if the situation, though, it's not like a usual monetary or fiscal problem, this is a again historical health problem that's causing all kinds of other problems. That's affecting everything. It's not just like, I mean, it's like basically this is what's ruling our life. So if we have a problem that's lingering and we don't know when it's going to get fixed, I don't think that's the low then. Because if we had, let's say, a monetary situation, let's say exports are low, projections are low, market goes down, then at 22.50, people say, you know what, it got priced in, let's go buy. Well, that's great, because we can expect, we have some basis of a baseline of expectation that we can kind of calculate or can project. This is not the situation. So that's my rationale why I don't think that's a low. I think this is a head fake out move. And so, 2,800, right? So now what happens in a, actually let me, all right. Let's say 2,800 right there. So what happens in a like recession move or bear market move whenever some kind of crash like this happens? And if we are in a recession, this is not a correction. If we're in a recession, this is not a correction. We're assuming this is not a correction. This is going to be the world's biggest correction ever if this is just a correction, which probability-wise is not likely. Because, so let's say that at 2,800, we're at 2,800. So the way that pricing usually, the pricing dynamic or the market, the way that it behaves is we're at 2,800, and then it just doesn't go down straight, not like that. Because, I'm just drawing a straight line, but it didn't go up to 2,800 straight either, right? So it just had some like boom, 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 kind of in like a zigzag pattern. So we're at 2,800. So the market, what it does is usually when we're in a bear market or in a recession, the way it works is that it will stop out. Let's say assuming that we're stopping over here, at some point my basis is that my position is that, projection is that we're going to stop moving up. Let's assume that we stop moving at 2,800. What's going to happen is it's going to kind of like bounce around because it will not have the strength to move up anymore. If you look at the volume of the market as it's moving up, the volume, relatively speaking, when it was going down is lower, which tells you that number one, this is an anecdote. not an anecdote, it's tangent. um, what happens that when there's low volume, that means that there's not enough participation. That's a weaker move than if you had the same move with higher volume, a lot more people participating. When the market moved up, the volume was low. Also, you have to also keep in consideration that a lot of people are closing out the shorts. That means it's a short trap, right? So in other words, like what happens is that a short is basically when people sell. You can actually sell over here and buy it back. This is a term for a lot of traders. A lot of traders do that, right? Institutions, this is just like eating. Sorry, so that's my dog there. Wow, she's quiet now. So what happens is that when you're short over here, you're buying it back because maybe it's like, okay, you know what, it has gone too much. And I buy some of it back, or some people come and say, you know what, it's too cheap, let me buy in. But what causes then is that if it starts moving up, all those shorts are getting closed out. In other words, they're buying back to close their short position. The market keeps on moving up. So you have low volume and also at the same time short closing, which is not necessarily a strong move, and it's not a good sign as far as the viability of that upward movement keeping on being an upward movement. So what happens is in this rebound, market will just kind of like bounce around a little bit, right? And then kind of slowly tip over. And then at some point, it will just gradually tip over. Right? It will kind of gradually tip over. And then what's going to happen is that you're going to have some like bad news, and all of a sudden, boom, you're going to have some big down days, and then it's going to kind of hit this low again. And then usually what happens is that the previous low, it will kind of bounce around there. And then what happens that if it is in fact a bear market or again a recession, which is what I've been saying, I'm kind of positioning, kind of like going over why I think it's a recession again so many times. That if it's a recession, then what happens that it's going to break that. It's going to break that, and then usually when it breaks that, a lot of people were hoping and who were getting in on the market at 2250, who were hoping that's a low, they sell out, and the market then does another like big giant drop. And then it kind of, bounces around again, usually because, again, it gets priced in. And usually this is when you find a low. Again, when nobody's buying. If my cousin and friends are calling in and saying, F the market, I'm out, whatever, or, I don't want to, this is all BS. I hate this, whatever, screw this, I've lost so much money, I'm going to get out, right? Whatever. So, and so that, then they ask me like, hey, how do I get my money out rather than, hey, what should I buy? So what happens that when that happens, you're going to have like a last bit of down move, another big drop. And usually, that's the low, right? That's, in other words, we have a consistent down move with markets consistently going down. And that is, the context is that happens in a bear market or in a recessionary environment where you have consistent pressure to the downside. If in a recession, which it's going to be one of those recession that, you just can't like, hey, low taxes, hey, we'll lower your taxes. We just have like zero interest rates and all this kind of stuff, and it's going to fix everything. If this problem is going to be consistent, and the other point is that my belief is that this is this disease is nobody's seen this, so the effect of it is I think people are underestimating its effect and its lingering effect, I don't, if that's the case, then we're going to have consistently bad numbers macroeconomically, which would also impact the market. We should have a market that keeps on going down, and this is not the low. The market's going to be definitely going to go down, and my thought process is that once people, because a lot of people are still, there's going to be a vaccine or whatnot. Think about it. They're saying the vaccine will be about year to year and a half out, right? It's like everything's year to year and a half out. So maybe we'll go back to a job, but if for a year to year and a half, the GDP keeps on going down like 20% every quarter, let's just say, because it's not like we're gonna go back to work and work at the same type of job, the same intensity and all that kind of stuff like we did before, right? Our ability to create economic activity will not be as high as it was before. Then we're gonna have, if that's the case, we have a consistently, that's going to be our future, at least for the next few quarters or so. Then we're going to see the market go down even more. That's my thesis. Or that's my thesis. And so again, those are why I think what's going to happen is what's going to happen. Now the question is, how do you protect? By the way, again, I'm not advising or giving any kind of guidance or none of that. Like I said, I do have all my license and everything, right? But I'm not speaking of as an advisor or anything like that. I'm not, and again, I trade for myself now. I'm out of the financial quote unquote industry officially, at least. But I still trade by myself. I'm self-employed. But this is not an advice, and this is nothing that I just think that people should be aware of what might happen in the future, this is what I think this is a high probability event likely to happen. Now, what can you do to keep yourself safe? I mean, this is all doom and gloom, right? But so there's a few things you can do, and in fact, you might even make money, right? So there's a few things you can do. One is you can short stocks that you think will go down, right? So in other words, the same way that I'm saying shorting. Shorting is basically when some guy, says that I'm selling instead of buying. You can actually do that because, you call your broker and they will say, I'm gonna short. You can say, I'm gonna short. What they do is they give you some shares. They're gonna lend you some shares for you to sell. And then your job is to hopefully the market goes down and you buy it back at a cheaper price. You make money. So what you could do is short it. So if you have, $100,000 portfolio, you can buy, you short some few shares of Apple or whatever, something like that, right? I'm not saying, again, I have to kind of, this is not an advice. I'm not saying, let's take that back. I'm not saying short Apple as an advice. I'm just short whatever you think is going to go down. Or you can just short the market in general, which you can short like SPY, which is an ETF that tracks the market. So if the market goes up, SPY goes up by the same percentage, almost the same. But the point being that you get that exposure to the downside if the market goes down. The other thing you can do is buy ETFs that track the market but does the opposite. So in other words, for example, SH is a ETF. Now there's a bunch of the ETFs that you can do your research and look at what else you can buy. What it does is the market goes down, 1%, that ETF theoretically should go up 1%. So it's not, they don't track exactly 100%, but almost 100%, like 99%. So I don't want to go into that because it's the way that they're structured, that ETFs are structured, that they almost get you, like the same return. So now that's going the ETF route. Again, there's a whole bunch of them. You can do SH, you can do the financials, you can do, you name it. Anything. The transports, things that take the most hit, hospitalities, or you could just do the market. Just keep it simple. You just buy an ETF that shorts the market in as a whole, right? And especially if you have like a 401k or a well-diversified account, that's effectively kind of like, treating the investment as and is getting exposure to the market on a holistic basis. In other words, it's not just buying one or two stocks. Okay, so let's go in the ETF route. Now, the third option is, I think, what's best for most people. It's what's called buying an option. So if you think that you have a stock, let's say you have Apple, what you can do is you can buy a contract, what's called a put option, where you have the right to sell that stock at a certain price within a certain period of time. So that protects you if the market goes down on Apple. So for example, let's say, assuming that Apple is $100, right? And you buy a put at $90, what that means is that you have the right to sell Apple at $90. So if the worst comes to worst and Apple's at $10, well, guess what? You don't have any losses below $90 because you're selling your Apple at $90. Again, protection, some insurance. And that's probably the best one because it's capital efficient, because it doesn't usually cost, you're not taking a big position. That's the thing. When you're shorting something, buying up ETFs, you're putting on, it's like buying a stock or selling a stock, right? So it's a big position. When you're buying options, these are like IOU, I think of it like IOU type stuff. So it's basic contract. They're usually much cheaper than going the stock route. The fourth option is what you can do is buy a futures contract. Those are there's also other steps you can take. Complicated. I'm just going to keep it simple. So these are the four things that I think most people have access to. Even futures is what obviously most people don't have access to. Options are even advanced for most people, but that is available to everyone. You can just call your broker and say, what of an option? Like put options. So let's go back to futures. The fourth one is futures, where you can buy or sell the market as a whole. So you can sell a futures contract, and so the market goes down, you make money. However, though, it is you're taking risk. You're taking because there's a lot of leverage in it. So if the market goes down, and number one, you have margin requirement and also the leverage effect of it, because the market goes down, you go down $50 for every dollar that, let's say, E-mini goes down. That's the S&P futures contract. The whole thing, though, is that there's ways that you can weigh your account, and you can sell enough futures contract to kind of like balance out if your whole account goes down by a certain amount. So in other words, you can weigh your account, and let's say if S&P goes down 1%, your account will go down 2%. So you can then sell a futures contract that will basically counteract the 2% down move of your portfolio. However, it might be a little bit too. It might be more. It's really more advanced. For almost everyone, the most effective way or the cost-efficient way will be buying an option. So you can do two things. You can there's many ways actually with options. You can do many things. You can either buy an option on SPX, so you can buy a put option on literally S&P 500 or the other indexes. Or you can buy a put option on SPY, which is the ETF, the biggest ETF and the most traded ETF in the market that tracks the market in general, S&P 500. Or you can buy put option on the stocks that you own. That's also something you can do, right? So, in other words, let's say you have an Apple, you bought it, like my example, you bought it at 100, you can buy an option at 90 for like $1, let's say. And so that means that option is for like 6 months out. So within this next 6 months, if the market goes down, Apple goes down below 90, guess what? You can sell your shares at 90. Let's say Apple, if you had, let's say, I don't know, like you had an option on S&P 500 at 3,000 when the market started moving down from 3380 or whatever, right? It might have cost you maybe like $1 or $2, and you'll be millionaire or something. All that assumes that you're going to put all your money in that option, which is don't do that. But I think that's going to be a few ways that you can take a look at it. That's the good news. I don't want to necessarily all the bad news or at least bad projections, not necessarily news. And this is some ways that, again, a trader, investor, whoever, whether they have experience in the market, like, you know, for 18 years like me, or working in industries, having licenses, dealing with things, that's not, you know, we don't know the future. What people do, what makes the difference is that they have some, you know, expertise, some experience, some tools, some knowledge that you can like bring to bear, right? You can like bring it to the table, and that helps you can come up with a game plan, right? A course of action. First you do projection, then you find out, you know, how does it impact us? What is your goal? And then, you know, how can we use a projection to our benefit? What is the best efficient way to do that? On and on and on. So those are the steps. So, you know, I just want to kind of like those 4 things that I want to say, like, you know, maybe you can call your broker and do some of the, take some of the steps if, you know, and they're, again, these are not like, you know, I'm not telling you, you know, you don't have to like sell everything, right? These are all insurances. So in case something happens, let's say I'm wrong, which I hope I'm wrong. Actually, to be honest, I'm 50-50 on it. If I'm wrong, I look like an asshole. If I'm right, then, well, I still look like an asshole in a sense, but at least I'm right? So, and so that's, but that's some of the few, you know, ways that you can keep yourself safe. And this is, you know, I just want to go on a good, you know, positive note and kind of give you a solution, right? Solution to what could be a future problem. So if you do have this future problem, you can take some of the steps now to keep yourself safe for the future, or you can do it later too, I guess, but it might be too late. But, you know, you can wait for it to move down a little bit. But anyway, that's my, you know, 2 cents. And yeah, so that's my 2 cents. Yeah, so anyway, I was gonna think of, I had some other thoughts, I forget. I've been talking so much, you know, I like talking, by the way, but sometimes things just happen in your head, and you don't say it at the right time, and boom, they go away. Yeah, so anyway, everything that I said is all, you know, none of this is an advice. None of these are, I'm not guiding you or anything like that. This is all for your informational, educational, even like entertainment purpose, right? Yeah, and like I said, you can watch some other videos that I did on this channel, Trader Sid and Trading Show and The Trading Show on YouTube and The Trading Stream on YouTube, and kind of go over some of the methodologies, the rationale, why I thought the market was going to go down, you know, significantly. It definitely went overboard in my expectation, right? And I you know, so, you know, I made the right call on that. However, at the same time, we don't know the future, right? So we're not God. But what we can do is take steps to, or have strategies in place to keep ourselves safe in case something happens. But yeah, and also I will be, you know what, I was thinking of doing this like on a paper format too. So I might actually just make like a small like PDF or something like that, like a, I don't know, small like a school report or something. That'll be a little bit more, I don't know, maybe like accessible to most people. Because when it's a long format, when I'm talking, maybe if I'm doing a PDF, maybe it could be a short little video, you know, paper format. So maybe I don't know, maybe a little bit more, and people can have it in front of them so they can like go back and forth instead of seeing me talk for half an hour. So with that said, I hope everyone stays safe. I thank you for watching my little short video, right? And I hope you stay safe, and also hope your finances and your investments stay safe, or at least, you know, the least, you know, at least they're not harmed, right? The least I can do is kind of provide maybe a few ways to maybe think about how to keep your positions and your investment safe. Anyway, my name is Sid Chowdhury, and thank you for watching me. And I'm surprised that I didn't start to like sneeze and all that kind of stuff. So, although now my nose is getting hold on, sorry, a little watery. But anyway, sorry for that. That was not professional. Now this is professional. So anyway, hope you stay safe. And if you do have any questions or anything like that, you can always put a comment and or just reach out, on the internet, and yeah, we can ask any kind of question, anything that you want to. So anyway, hope everyone does well, and put your mask on and make sure you're not, you're stay the hell away from people coughing, or if you're coughing, don't cough with other people, and don't be an asshole. But anyway, I hope everyone stays safe and take this thing seriously. It's going to be in here for some time. It's going to be with us for some time. So thank you, and bye.